Alphabet Inc., otherwise known as Google, ticker symbol GOOG, is currently trading at $160.76 per share. If we look at the stock over the last year, it's actually down around about 6%. It was dropped from its all-time highs at about 208, about 22% decrease since that time. But if we look over the last 5 years, it is up almost 134%, which is beating the S&P 500. Now, Google has had a bit of a slowing period, but is currently trading an 18p, which is potentially very low for a high growth tech stock, despite the issues Google is currently having. What we're going to be doing is going through their most recent earnings. This is the first quarter of 25, and then going to my automated stock valuation spreadsheet to see if it's a buy or a sell. So let's just put in the ticker GOOG, and this will load up all the latest company financial data so we can have a deeper dive. If you're interested, check my Patreon. It is the $4 tier. So let's get back into this. As said before, Alphabet Inc., $160 a share, market cap just shy of 2 trillion, PE ratio of 18.22, which is a lot lower than the market average, which is at about 28. Earnings per share, $8.83, a beta of 1, so slightly more volatile than the market, and analysts do have it as a buy just shy of $200 a share. Now, they do pay a dividend, 0.54%, meaning you'll get 87 cents a share. It's a very safe dividend. They pay out $4.7 billion, which is about 4% of the net income and 6% of the free cash flow. And if you want to buy it, buy before the 9th of June, and you get paid your quarterly dividend. So just revenues here, trailing 12 months, all-time highs, 360 billion. Now, if we go back to the earnings, we can see here. So we have quarter of 24 versus 25, revenues up about 10 billion, which is increase here. And if we see it, how it's broken down, this is 25 versus 24. Google Search and Other, the largest segment, 50.7. Ads up about a billion, 8.9 compared to 8. Google Network down. But if we look at the split, which is broken between advertising and subscriptions, ads is up and subscriptions is up. And then obviously we have it's broken down here again, which is Google Services up about 7 billion, Google Cloud up about 3, others down slightly, and you've got the hedging gains, which is up as well. But overall, revenues are up, which is what we want to see. In terms of the let me just go back to here. In terms of net income, are they generating more profit? Yes, all-time highs, 111 billion, possibly the most profitable company in the world. Free cash flow, all-time highs, just shy of 75 billion. If we look at operating cash flow versus capex, operating cash flow all-time highs, and capex is increasing, but they still got a lot of free cash flow. Shares outstanding, they're buying back shares. And also, if we go back to here, let me just scroll down a little bit. April 23rd, the board of directors are repurchasing an additional 70 billion of Class A and C shares. So they're continuing to reward shareholders, and this will keep on going down. Also, just before we go on to that, dividend payments, 1.2 billion, 170 million, and 1.8 billion, resulting 2.4 billion for the 3 months ending 25. They declared a quarterly dividend of 21 cents, which is a 5% increase of the previous one of 20. So they are increasing their dividends, they're buying back shares, everything is growing. Seems like a no-brainer. Let's just continue. So this is a discounted free cash flow model. It's initially giving us a price of 165, so a buy. Low free cash flow ratio and average free cash flow ratio. Let's see if we agree with it. So we do have 382 and 406 billion in terms of the revenue or expected revenue. Let's see if analysts agree with us. A little bit higher, 387,428. So there we'll bring this up a little bit. That brings us to $175 a share. Net income margins, I think these have been increasing. So we can probably bring that up to about 27.5%. That puts us at 179. Net income to free cash flow all over the place. But I think even if we bring this down just to 80%, you can see it puts it at about a buy. So discounted free cash flow model does say it is a buy. Slightly undervalued, but I would say this with the net income, it's probably, see, $180 a share. So definitely a buy on the discount free cash flow model, which is rare for these high growing tech stocks. Dividend discount model, have a quick look at that. Well, we can't yet because they've only paid dividends for a few years, but soon we'll be able to see this increasing, which would be good. Ben Graham formula for intrinsic value. Now, Ben Graham doesn't like too many stocks at the minute due to the high bond yields. but let's just have a look anyway. So next year, expecting quite small growth, about 6%, so that puts it $100 a share, so I'm not a buy there. So finally, let's have a look at the comparable company model. This is the way of valuing stocks, looking at their competitors. And the metrics, the things we're looking at initially is revenue growth rates of 1 year and 5 year, EBITDA, net income, profit margins, price to sales, price to book, PEG, and then the specific metrics that go into the model: EV to revenue, EV to EBITDA, PE, and forward PE. So just looking at the S&P 500 top constituents, we have, I think Apple is a good one, APL. We'll also do Microsoft, and we will also do Meta. And what this will do is it'll load up all the latest company financial data so we can see and have a compare. Currently, Google is the 8th biggest stock, going from highest to lowest. You've got Microsoft, Apple, Nvidia, Amazon, Meta, Broadcom, Berkshire, and then Google, and then Tesla, and then JP Morgan. But I think these are pretty fair comps. Revenue, Google second highest. Enterprise value, it's the bit bigger than Meta, but less, or considerably less than Apple and Microsoft. Revenue, second highest. Revenue growth rates, highest. Towards the top. 1 year revenue growth rate, not as much as Meta or Microsoft, but definitely beating Apple. EBITDA, towards the top. Net income, most profitable, 111 billion. Margins, 30%, which is a lot higher than Apple, but not as high as Microsoft or Meta. Price to sales, current market average is around about 3. Higher than that, but the lowest out of these. Price to book, market average is around about 5. Once again, over that, but lower than these. PEG, Peter Lynch's price to earnings growth. Ideally, want this under 1. None of them are, but once again, Google is the lowest with a 1.2 compared to the other ones too. EV to revenue lowest, EV to EBITDA lowest, PE lowest, forward PE lowest, giving us an average price around about $230 a share. So comparing to all of these, Apple, Microsoft, and Meta, it does look like a buy. So just to recap, discounted free cash flow model has it at undervalued. Ben Graham formula hates it, but he hates everything at the minute. Dividend discount model we can't use because it doesn't pay enough dividends or hasn't had enough historical dividends. And comparable company model does have it as a pretty big buy. So just quickly, also, if we were to compare, we did Meta, we did Microsoft, and we did Apple. Over the last 5 years, you can see that Google is at the lowest, Alphabet is at the lowest, 134%, 144, 175, 211. So that does suggest that it is undervalued, you can see here. And then over the year as well, the only stock that is down, Meta up 40%, Microsoft up 8%, Apple up 13%, Google down 5%. So is this a buying opportunity? It does look like it. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.